If a cooperative is profitable, the board of directors can redistribute member-based profits back to patrons. This is a tremendous benefit because members can receive patronage in the form of cash or also as an investment in the cooperative. Cash patronage is just cash received by member patrons for doing business with a co-op. But what is the portion of patronage that is retained as an investment? What is its purpose? What benefit does it provide? The key to answering these questions is understanding allocated equity.
Allocated equity is a member-patron investment in the cooperative. It can also be thought of as retained patronage. At the end of each fiscal year, the board of directors determines the amount of patronage that is distributed back to the membership. A portion of this patronage can be held by the cooperative as a member investment or allocated equity. The way the cooperative keeps track of allocated equity is by putting the member's name on this equity stock. That way, it is clear to the member patron how much equity investment they have in the cooperative.
Remember that allocated equity are member-based profits, and profits are taxed. Yes, even profits generated by the cooperative are taxed. However, cooperatives are Subchapter T member-owned corporations, so the government will only tax these profits one time. This is known as single taxation, which means either the member pays the tax or the co-op pays the tax, but not both.
Cooperatives retain patronage refunds as allocated equity for several reasons. First, allocated equity are funds used by the cooperative to finance investments. Grain storage, fertilizer warehouses, and spray rigs are just a few examples of investments that require funds to finance their purchase. So allocated equity is one source of financial funds. Another reason cooperatives will use allocated equity is because it is a clear direct tie to member investment. Remember that allocated equity is stock that has the member's name on it, and this type of equity is used to finance investments. So if these investments like grain storage, fertilizer warehouses, and spray rigs are delivering value to the members can rest assured that the stock with their name on it is being used to their benefit.
The final benefit of allocated equity is that it will be returned or paid back to the member in the future. This is what is known as equity retirement. At the end of each fiscal year, the board of directors will discuss how much allocated equity can be paid back to the membership. Not all of the equity can be retired at once because the cooperative needs to finance its investments. However, if the cooperative is profitable enough, retiring or returning some allocated equity back to the membership is yet another benefit of the cooperatives.
There are three benefits of allocated equity: financial funds for investments, direct tie to member investment, retire allocated equity back to the membership. But how is equity actually retired or paid back to the member patron?
There are three primary equity retirement programs utilized by co-ops. The first is paying estates. If a member passes away, then the board of directors can elect to retire that member's equity to their estate. The second equity retirement program is Age of Patron. A cooperative with this program will return allocated equity back to the member patron when they turn a certain age. As a patron builds his or her allocated equity through time, the cooperative will hold these funds until the patron turns a certain age. This age is stated in the cooperative's bylaws. When a member turns the given age, let's say 72, then the board can elect to return the allocated equity back to the patron, and the patron's allocated equity would return to $0.
The third equity retirement program is Age of Equity. In this program, the age of the member patron does not matter. What matters is the year in which the retained patronage was held as allocated equity. Think of this year as a born-on date for a member's equity investment. So the age of equity is what the cooperative board of directors will consider when making their equity retirement decisions. In practice, retiring equity according to its age is most commonly implemented through a revolving equity program. Let's go through a straightforward example. Assume a cooperative has 16 years of allocated equity. After careful consideration, the Cooperative Board of Directors decides it can retire 1 year of equity back to the membership. So now the cooperative has 15 years of allocated equity.
In summary, allocated equity is a tremendous benefit to members of cooperatives. Not only does it help fund investments, but the equity can also be returned back to members in the future. Receiving value today and in the future is how allocated equity provides a tremendous benefit to members of cooperatives.